Hello everyone, we are Group 18. Our report topic is Visa vs MasterCard, a global payment drive showdown. This presentation will deeply explore the development history, core business models, market influence, and key differences between the world's two largest payment network giants, Visa and MasterCard, helping you better understand the working of the credit card world.
Accounting standard. Visa and MasterCard both adopt accounting standard issued by the Financial Accounting Standard Board and follow US GAAP. This means the two companies use the same accounting framework, ensuring compare of their financial statement. Asset, liability, equity. From 2022 to 2024, Visa has a larger asset base and maintain more stable growth, while MasterCard shows faster expansion. MasterCard leverage is higher, indicating higher financial risk, whereas Visa maintains a more conservative and stable financial strategy. Total revenue growth. Between 2022 and 2024, Visa appeared to be in a mature stage, showing stable but slower revenue growth. MasterCard remained in a late growth stage, driven by innovation and expansion into emerging markets. Overall, Visa represents stable maturity, while MasterCard shows dynamic, innovation-driven growth. Operating cash flow. Visa demonstrates exceptionally strong cash conversion efficiency due to its fee-based model and low capital intensity. MasterCard cash conversion is slightly lower but improving as it invests in technology and expansion. This investment may reduce short-term efficiency but strengthen long-term cash generation. Return earnings. Visa return earnings increased in 2023 but declined afterward, likely due to higher shareholder distribution or one-time expense. MasterCard return earnings grow steadily by around 16% annually, reflecting strong profitability and reinvestment capacity. Current ratio. From 2022 to 2024, Visa maintained a stronger liquidity position than MasterCard. Visa current ratio declined modestly, but remained solid. MasterCard ratio dropped close to 1 point, indicating higher short-term liquidity and weaker coverage of current liability. Quick ratio. Both company quick ratio decline over time. Visa dropped below 1 point, indicate reduced short-term liquidity. MasterCard also show a downward trend, suggesting lower immediate financial flexibility. Asset turnover. Both Visa and MasterCard show improving asset turnover from 2022 to 2024. MasterCard consistently perform better because it generates more revenue per dollar of asset. Inventory turnover, however, is meaningless for both firms due to negligible inventory. NB ratio. Both company NB ratio rise steadily, reflecting strong market confidence. MasterCard ratio is significantly higher, showing stronger EBITDA expectation regarding future growth, brand value, and intangible asset. Visa also benefit for rising valuation driven by global payment demand.
This page shows the cost that Visa and MasterCard need to run their payment service. From 2022 to 2024, both companies had higher and higher costs each year. MasterCard costs were a little higher than Visa. Even though these companies don't sell products, they still need to spend money to process payment. This page shows the operating expense, which are the daily costs of running a business. Visa and MasterCard both spend more money every year from 2022 to 2024. MasterCard expense grew a little faster. This means both companies need more money to keep their payment network working. On this page, we look at other income, other expense, and tax for Visa and MasterCard. Visa had some big change in this number from year to year. Mastercard number also changed, but not all data was shown. Both companies had different tax rates each year. These numbers show how much money they keep after paying tax and extra costs. This page compares interest revenue and other revenue for Visa and Mastercard. Visa earned more money from its investment they spent, so it did well. Mastercard has some costs that reduce its profit from investment. This means Visa uses its money more efficiently. This page shows a common size income statement, which means we look at each number as a percent of total revenue. Visa keeps more profit and has smaller expense compared to Mastercard. Mastercard spends more of its revenue on costs, so it earns less profit. This shows that Visa is more efficient at making money. This page shows the current assets of Visa and Mastercard. Things like cash and money customers still need to pay. Both companies do not keep inventory because they do not sell physical goods. Visa had more cash at first, but its account receivable increased in 2024. This page shows the percentage of each type of current asset. Visa cash and short-term investment dropped a lot in 2024, while its account receivable grew. Mastercard stayed very stable over the 3 years. Both companies do not have inventory. This ratio helps us understand how each company uses its money. This page gives us a summary of all information. Visa is more efficient, earns more profit, and uses its money better. Mastercard has higher costs, but is improving each year. Even though they are different, both companies are important leaders in payment world.
In this page, we are going to discuss the advantage and disadvantage from the debt perspective. This sheet shows us about the total debt, shareholders' equity, and debt-to-equity ratio and current ratio from Visa and Mastercard. By this sheet, we can know Visa is more conservative and financially safer from the debt standpoint. And Mastercard carries higher debt risk but still remains financially strong overall.
I want to talk about the time interest earned ratio or TIE for Visa and Mastercard. TIE means how many times a company can pay the interest using its operating income. The formula is EBITDA divided by interest expense. For Visa, the TIE ratio stays very high across all 3 years, even though the exact value changes a little each year. They all show the same message. Visa earns much more than it needs to pay interest. This means Visa's strong profitability, low financial risk, and very safe interest coverage. Under our cross criteria, Visa is clearly in the strong position category. For Mastercard, the TIE ratio also comes extremely high and very stable. It shows the Mastercard keeps strong earnings and doesn't rely heavily on debit. The company can comfortably pay its interest with its operating income. So just like Visa and Mastercard also fits into the strong position category. In conclusion, both Visa and MasterCard have strong profitability and low financial risk.
I will compare Visa and MasterCard using 3 simple points and explain what these singles tell us about the stage of business cycle. First, their EBITs keeps growing each year. Visa's EBITs grew 15% from 2023 to 2024, and MasterCard grew 17%. This growth both companies are making more money because people are spending more and processing more payment. This kind of steady profit growth usually happens during an economic expansion, when the economy is doing well. Second, both companies have higher times interest earned ratios over time. Visa's went from 46 to 52 to 58 times, and MasterCard went from 41 to 49 to 54 times. When this number gets bigger, it means profits are growing faster than the interest cost. In simple terms, they can easily pay their interest. This is another sign of continued expansion, not slow down. Finally, their leverage is going down. Visa's dropping from 0.55 to 0.5, and MasterCard from 1.8 to 1.55. Low leverage plus strong interest coverage shows they are not talking on too much debate. Their financial position stays safe and steady. Overall, all these signals, raise profits, strong ability to pay interest, and low leverage, point to the same conclusion. Visa and MasterCard are in the economic expansion phase.
I want to talk about the profitability ratios ROA and ROE for Visa and MasterCard. ROA shows how well a company uses its assets to earn profit, and ROE shows the returns to shareholders. For Visa, ROA stays very stable around 20%, which means Visa uses its assets effectively. Its ROE keeps increasing and stays above 40%, showing strong and steady profitability. For MasterCard, ROA is also strong, around 27% to 29%, meaning the company is very effective in using its assets. ROE is extremely high and keeps rising, showing very strong return for shareholders. In conclusion, both Visa and MasterCard shows excellent profitability and healthy financial performance.
And in this page, we are going to using DuPont analysis to calculate Visa's net profit margin, assets turnover, equity multiplier, and resulting return on equity for the past 3 years. And first, we're going to find the Visa's and MasterCard's revenue, net income, and total assets, and shareholders' equity. And this is substitution and approximate calculation from Visa and MasterCard from 2022 to 2024. And this is DuPont's analysis formula. And based on the above calculation, we obtain the following table.
How their return on equity changed on 2022 to 2024. For Visa, ROE went up steadily from around 42 to about 50%. This rate happened mainly because the company's business became stronger. Visa net profit margin went from 51 to 55%, and its asset turnover increased from 0.34 to 0.38. This means Visa made more profits from each dollar of sales and used these assets more efficiently. The equity multiplier stayed almost the same at around 2.3 to 2.4, which shows Visa did not take on too much extra debt. Overall, Visa's higher ROE came from real business improvement, so its performance looks stable and low risk. For MasterCard, ROE jumped a lot, from about 158% to almost 199%. But its big increase did not come from better profit margin or better use of assets, because those stayed about the same. Instead, the rest mainly come from much higher leverage. The equity multiplier increased from 6.1 to 7.4, meaning MasterCard used more debt or share buyback to boost ROE. This can raise return, but it also increases the financial risk. In short, Visa's ROE grew because its business truly improved, while MasterCard's ROE grew mostly because of the higher leverage. This makes Visa's performance more sustainable in a long run. This is an overall assessment for Visa and MasterCard focusing on their profitability, liquidity, solvency, efficiency, and valuation. Starting with Visa, the company shows strong and growth profitability. Its net profit margin and asset turnover are both rising, and its ROE is increasing mainly because the business itself is performing better, not because it is using more debt. Visa also has very strong liquidity with steady cash flow that easily supports dividends, share buybacks, and investments. Its solvency is also very safe. Visa uses only a small amount of debt, has very high interest coverage, and keep financial risks low. Efficiency is improving as well, shown by higher asset turnover, means Visa is using its global network more efficiently. In terms of valuation, Visa stock is priced higher because investors trust the long-term business strength. Though this also means the company could react more strongly to slower payment growth to regulatory change. Overall, Visa is a higher quality global payment company with steady performance and excellent financial discipline. For MasterCard, profitability is also very strong and continues to rise, helped by growing transaction volume and good cost control. However, its big jump in ROE mostly comes from using more financial leverage. Liquidity is still solid, supported by stable operating cash flow, but MasterCard's solvency position is more adjusted. Its equity multiplier is above 7, which increases return but also raises financial risk. Efficiencies remain good but no longer improve much. Like Visa, MasterCard stock trades on a high price, but its heavier use of leverage makes it more sensitive to market swings and change in the economic environment. In summary, Visa delivers stable, sustainable growth with low financial risk, while MasterCard offers higher return with higher leverage-driven risk.
First is Visa. Visa shows strong and stable performance. Profitability is improving, so its buy or hold. Equity and solvency are strong, so both are buy. Efficiency is steady, so hold. Valuation is a bit high, so hold or sell. Overall, Visa is a high quantity company, so the final view is hold with a tilt toward buy. and is Mastercard. Mastercard shows even higher growth. Profitability is very strong, so buy. Liquidity is stable, so buy or hold. Solvency is moderate, so hold. Efficiency keeps improving, so buy. Valuation is expensive, so hold or sell. Overall, Mastercard is high growth leader with a final view of hold with a tilt toward buy.